Hello, I'm Stacy Acevedo, an instructor for Investools, a hedge fund manager, and a writer for an international newsletter. And I'd like to welcome you to the Advanced Technicals course. This multi-part course is designed to introduce you to the world of advanced technical analysis, one step at a time. Each topic discussed in the series is designed to build your confidence and understanding of the tools available to you as an individual investor. Technical analysis will be somewhat of a departure from the previous courses you may have taken. We will not be analyzing option chains or fundamentals. As a trader, you can choose the market and the instrument type you want to use because the principles you'll be learning are transferable to almost any market where there are sufficient buyers and sellers to create liquidity. This program is designed to help you understand how to implement advanced charting techniques, how to identify buy and sell signals from the price action of the market, which advanced technical indicators work best, and which methods suit your own investing style. This course is intended to build on the technical analysis information already discussed in the 5-step online investing formula and the 7 cash flow investing strategies manuals in the accompanying DVD series. As you begin this course, you will hear concepts that should be familiar to you. This course assumes you have a beginning level of proficiency with the interactive chart in the online investor toolbox. If you need a review, use the interactive chart tutorial included in the manual. We'll start out slowly with a review of the basics of technical analysis and then build up to the advanced topics. In the segment 1, we'll discuss basic charting and candlesticks. Segment 2 will cover support and resistance. Segment 3, price patterns. Segment 4, trending indicators. Segment 5, we'll go over oscillating indicators. And lastly, in Segment 6, advanced technical analysis. You should use this video course in conjunction with the Advanced Technicals Personal Training System workbook. The workbook will test your understanding of the material and get you ready to begin placing your own trades. Because technical analysis involves trading the upside and the downside of the market, it is ideal, but not necessary to have short selling and options trading approval from your broker. Take the time to solidify the concepts in your mind by reviewing the DVDs. Your coach is also available for email support with questions that may arise following the workshop. Make sure to take advantage of the resources available to you. The information in this manual was compiled for a purpose of financial education only. The manual uses examples of specific stocks and stock symbols to aid in the learning process and should not be construed as recommendations to buy or sell securities. Now, let's first turn our attention to the concept of technical analysis, and then we'll go on to discuss basic charting. Technical analysis is used in investing as a discipline that attempts to identify investment opportunities by analyzing the physical behavior of the market. These behaviors include price movements, volume, and open interest. Technical analysts or technicians do not attempt to determine the intrinsic value of a stock as a fundamental analyst would. For example, if a fundamental analyst went to a grocery store, they would study the ingredients of each item and try to determine what they should purchase by identifying the highest quality ingredients or a combination of the ingredients. Technicians would sit back at the checkout counters and observe what other shoppers are buying to determine what they should buy. Technicians must ensure that the market has one key characteristic before they attempt to trade it. That's liquidity. Liquidity reduces slippage. Entering a trade and anticipating a certain price based on a technical indicator, but having to settle for a less desirable price due to lack of buyers and sellers on the other side of the transaction. As a general rule, the average volume should be at least 250,000 shares per day. That should provide ample liquidity. A good test is to paper trade the market or stock under consideration before trading with real money. This may help identify unseen pitfalls. Now here's an investor tip. Keep in mind that technical analysis works best in a market with high liquidity. There are 4 basic benefits of technical analysis: clarity, simplicity, flexibility, and universality. First of all, clarity. Technical analysis helps eliminate ambiguity. Technicians operate under very specific rules. They know when they will enter a trade, and they know in advance when they will exit the trade. Technicians live by the adage, plan your work and work your plan. Secondly, simplicity. Technical analysis is simple. Technical analysis does not require an in-depth education in fundamentals and financial statements. Technicians can use very simple systems to make money. The real secret to technical analysis is to be disciplined. Thirdly, flexibility. Technicians can profit from both bullish and bearish market conditions. Technical analysis is an effective barometer of investor sentiment on either the upside or the downside, while fundamental analysis does not have much predictability on the downside. And lastly, it's universal. Technical analysis applies to any liquid market. Technicians do not need to learn a new set of technical rules or fundamentals when they move from market to market. They can trade stocks, options, futures, currency or bond markets utilizing the same tools and applications. Now that we've discussed the benefit of technical analysis, we'll move on to basic charting. But before you dive into the complexities of various technical indicators and their interactions with the market, you need to understand the basic functionality of a technical chart. You should also familiarize yourself with the interactive chart on the Investor Toolbox, which we'll go over in just a moment. Technicians live by the mantra, the trend is your friend. Trading with the trend can help you out in many dangerous or risky situations. Technicians often use multiple time frames to confirm their trading strategies. For example, if you're trading the daily charts using the stochastics indicator and you have a buy signal, you can check out the weekly or monthly charts to make sure you are trading with the trend longer term. Now let me show you how to adjust the time frame on your interactive chart. You can adjust the time frame by using the toolbar at the top of the interactive chart. To adjust the time span of the chart, click on the second drop-down menu from the left. You can adjust the time frame by using the toolbar at the top of the interactive chart. To adjust the time span of the chart, click on the second drop-down menu from the left. When you get a chance, try adjusting your chart from a 1-year daily to a 5-year weekly chart. The same principle of looking to the next time frame for trend consideration can be used with the hourly and daily charts. The daily and weekly charts, and even the weekly and monthly charts for a longer-term trader. The principles of technical analysis apply equally to each of these time frames. Now we'll discuss the different types of charts that technicians use. The oldest and most popular chart type is the Japanese candlestick chart. Another popular chart type is the bar charts. Bar charts are a Western invention and have provided a profitable blueprint for investors for more than 100 years. Another less popular chart type is the line chart. Line charts, however, can provide valuable information in specific situations. Other chart types include volume bar charts, the pivot point charts, and the oldest Western chart type created by Charles Dow of the Dow Jones Industrial Average, the point and figure chart. Let's take a look at a bar chart first. Now, a bar chart is a commonly used Western method of charting price movement. The long vertical line, the bar, represents each period's trading range, including the high price for the day and the low price for the day. The horizontal line on the left side of the bar represents the opening price for the day. The horizontal line on the right side of the bar represents the closing price for the day. As you can see from this example, the bar chart has obvious advantage of being able to see at a glance whether the market was rising or falling during a particular trading period. Something to keep in mind with line charts is that line charts provide clear support and resistance levels. Now remember, a line chart does not plot the price movement for a given period. It only plots the closing price for each period. The chart then connects the closing prices with a single line, hence the name line chart. At first glance, this chart type seems inferior to the bar chart because it displays less information. But as you can see here, why some technicians like this view because it usually shows support and resistance more clearly than a bar chart does. When it comes to using the toolbox, you'll find that you can adjust the chart type by using the toolbar at the top of the interactive chart. To adjust the chart type, click on the first drop-down menu from the left. We'll now discuss Japanese candlestick charts. A brief history about Japanese candlestick charts is Stephen Neeson brought them to the Western trading world in 1989. Before that, Japanese candlesticks have been used by the Japanese in rice markets since the 1700s. We will be using candlesticks as the primary method of illustrating technical formations in this program. Candlestick analysis will also be the first technical analysis method discussed, but before we do, I'd like to give you an investor tip about candlesticks. Each candlestick is composed of a body and an upper and lower shadow. Now, let's take a look at a candlestick chart. Like a bar chart, a candlestick chart shows three things: the opening price, the trading range, and the closing price. The range for the period is shown with a vertical line. The opening and closing prices are shown by the horizontal lines crossing the vertical line. The distance between the opening and closing prices forms a box called the body of the candlestick. The range of the prices above or below the body of the candlestick are represented by the vertical line, is called the shadow. If this closing price is higher than the opening price, the body of the candlestick will be left empty, or white. If the closing price is lower than the opening price, then the body of the candlestick will be filled in, or black. Candlestick charts are preferred by most technicians because they are generally easier to read. As you can see here, the up days and down days stand out from each other without losing any of the detail of the bar charts. In this segment, we'll be looking at the most common and reliable candlestick patterns used by technicians. Although candlestick formations can be traded by themselves, they are much more reliable when combined with Western techniques. There are a few basic types of candlesticks. You will use these basic candlestick types in each of the patterns that we'll discuss in this course. First off, white candles. The white candle is a candle with a long body that may or may not have an upper and a lower shadow. The long white body of this candle type indicates strong buying interest. Yet a white candlestick is not a standalone signal to buy or sell. Here's an example of a black candle. The black candle is a candle with a long body that may or may not have an upper and a lower shadow. The long black body of this candlestick type indicates strong selling interest. Yet a black candlestick is not a standalone signal to buy or sell. We'll now turn our attention to spinning tops and doji candlesticks. Before we move on to candlestick formations, an investor tip to keep in mind regarding spinning tops and dojis is that both spinning tops and dojis indicate a trading period in which the buyers and sellers were relatively balanced. Here's an example of a spinning top. The definition of a spinning top is a candlestick with both upper and lower shadow and a relatively small body. The color of the body is not important. While a candlestick with a long body indicates strong buying or strong selling interest, the small body of a spinning top indicates a slow market with a relatively balance between buyers and sellers. Yet a spinning top is not a standalone signal to buy or sell. A doji, on the other hand, is a candlestick with the upper shadow and a lower shadow, or both, and a flat body. Dojis occur when the stock closes at a price equal or almost equal to its opening price. Dojis do not have an elongated body, just a horizontal line indicating the opening and closing price. Like the spinning top, a doji is not a standalone buy or sell signal. A doji essentially is a neutral indicator because it represents a balance between buyers and sellers. There are, however, two types of dojis. They are not neutral. The first non-neutral doji is called the tombstone doji. As its name might suggest, it usually kills an uptrend and is generally bearish. A tombstone doji represents a trading period in which the price opened near the low for the period, experienced an unsuccessful rally, and then closed near the low for the period. Now let's take a look at the second non-neutral doji, the dragonfly. It usually flies upward and is generally bullish. A dragonfly doji represents a trading period in which the price opened near the high for the period, experienced an unsuccessful sell-off, and then closed near the high for the period. We'll now discuss candlestick formations. Candlestick formations provide technicians with both buy and sell signals. There are many different types of candlestick formations, some which fall outside the scope of this course. We're going to discuss only those formations that are central to the generally accepted technical analysis methodologies. The first two we'll discuss are the hammer and the hanging man formations. When it comes to a hammer, keep in mind that it is a common pattern that only occurs in a downtrend. It is bullish and signals a reversal of the current trend. Hammers are similar to the dragonfly doji, and they have little or no upper shadow, a small body and a lower shadow that is at least twice the length of the body. The color of the body of the hammer is not important. The hammer represents a trading period in which the price opened near the high for the period, experienced an unsuccessful sell-off, and then closed near the high for that period. The market is often described as hammering out, a bottom when this formation appears. As you can see in this example of the IBM graph, the stock price forms a hammer on 512 that is followed by confirmations on 519 when the stock price closes above the hammer. As with most technical signals, the hammer is not a standalone signal. Another signal must confirm the bullish action. A buy confirmation for a hammer occurs when a subsequent candlestick closes above the body of the hammer candlestick. Now, a hanging man is similar in form to the hammer, but the implications of this candlestick are quite different. A hanging man occurs only in an uptrend. It is bearish and signals a reversal of the current trend. A hanging man has a little or no upper shadow, a small body and a lower shadow that is at least twice the length of the body. The color of the body of the hanging man is not important. The hanging man represents a trading period in which the price opened near the high for the price period, experienced an unsuccessful sell-off, and then closed near the high for the period. Although the bulls may have rallied prices back up near the high for the day, a hanging man indicates the market is running out of steam. As you can see on this example of the S&P 100 index, the OEX, the stock price has formed a hanging man on 4.6 that was followed by confirmation on 4.7, when the stock price closed below the hanging man. Also note the hammer on 5.12 that was followed by confirmation on 5.25. The hanging man is not a standalone buy signal. Another signal must confirm the bearish action. A buy confirmation for a hanging man occurs when a subsequent candlestick closes below the body of the hanging man candlestick. The hanging man and hammer patterns are important technical signals as they represent major shifts in a market sentiment. There are four important things to remember about the hanging man and hammer: trend, body size, upper shadow, and confirmation. First of all, trend. The hanging man only occurs during an uptrend, while the hammer only occurs during the downtrend. The longer and more dramatic the previous trend, the more important the signals will be. Secondly, body size. The lower shadow must be at least twice as long as the body. The longer the shadow is compared to the body, the more valid the signal is. Thirdly, upper shadow. The hammer and hanging man should have little or no upper shadow. And lastly, confirmation. The hammer is confirmed by a subsequent candlestick closing above the body of the hammer, while the hanging man is confirmed by a subsequent candlestick closing below the body of the hanging man. Moving on, we'll now discuss inverted hammers and shooting stars. Starting off, here's an investor tip regarding them. Both an inverted hammer and a shooting star have short bodies and long upper shadows. They both indicate a change in their respective trends. The inverted hammer is a common pattern that only occurs in a downtrend. It is bullish and signals a reversal of the current trend. The inverted hammer, like the hammer, is similar to the tombstone doji. Taking a look at this example of an inverted hammer, you can see that they have little or no upper shadow, a small body, and a lower shadow that is at least twice the length of the body. The color of the inverted hammer is not important. The inverted hammer represents a trading period in which the price opened near the low for the period, experienced an unsuccessful rally, and then closed near the low for that period. The market can also be seen as hammering out at a bottom when the inverted hammer appears. Now let's take a look at this Standard & Poor's graph showing an inverted hammer. As you can see on the OEX, the stock price formed an inverted hammer on 5/19 that was followed by a confirmation on 5/21. The combination of the hammer and the inverted hammer during this period increases the strength of the signal. As with most technical signals, the inverted hammer is not a standalone signal. Another signal must confirm the bullish action. A buy confirmation for an inverted hammer occurs when a subsequent candlestick closes above the body of the inverted hammer candlestick. The shooting star is a similar pattern to that of the hanging man. You can see how the name shooting star came about because it looks like a meteor with a tail falling to earth. The shooting star only occurs on an uptrend. It is a bearish signal and indicates reversal of the current trend. The shooting star has a little or no upper shadow, a small body, and a lower shadow that is at least twice the length of the body. The color of the body of the shooting star is not important. The shooting star represents trading periods in which the price opened near the low for the period, experienced an unsuccessful rally, and then closed near the low for the period. A shooting star indicates the market is running out of steam. As you can see in this Intel example, the stock price formed a shooting star on 1/9 that was followed by confirmation on 1/13, when the stock price closed below the shooting star. The shooting star is not a standalone signal. Another confirmation must confirm bearish action. A sell confirmation for a shooting star occurs when a subsequent candlestick closes below the body of the shooting star candlestick. The inverted hammer and shooting star patterns are important technical signals as they represent major shifts in market sentiment. There are 4 important things to remember about the inverted hammer and shooting stars: trend, body size, lower shadow, and confirmation. First of all, trend. The shooting star occurs only during an uptrend. The inverted hammer only occurs during a downtrend. The longer and more dramatic the trend is, the more important the signal. Secondly, body size. The upper shadow must be at least twice the length of the body. The longer the shadow is compared to the body size, the more valid the signal. Thirdly, the lower shadow. The inverted hammer and shooting star should have little or no lower shadow. And lastly, confirmation. The inverted hammer is confirmed by a subsequent candlestick closing above the body of the hammer. The shooting star is confirmed by subsequent candlesticks closing below the body of the shooting star. We'll now move on to engulfing patterns. An engulfing pattern is more common than a hammer, hanging man, inverted hammer, or shooting star. Unlike in those patterns, the color of the candlestick in the engulfing pattern is important and must appear in specific sequential combinations of 2 or more candlesticks. There are 2 types of engulfing patterns: bullish and bearish. A bullish engulfing pattern occurs when a black candle is followed by a longer white candle during a downtrend. The white candle must have an opening price below the closing price of the previous black candle and a closing price above the opening price of the previous black candle. This indicates a critical market change in motion. The bulls are literally overpowering the bears. The bullish or white candlestick does not have to encompass the black candlestick shadows. Only the body of the black candlestick has to be surrounded by the white candlestick. As you can see in Yahoo Graph, the stock price formed a bullish engulfing pattern on 3/14 and 3/15. This signaled a change in the trend of a stock and was the beginning of a 33% increase in the stock's price. Now, on the other hand, a bearish engulfing pattern occurs when a white candle is followed by a longer black candle in an uptrend. The black candle must have an opening price above the closing price of the previous white candle and a closing price below the opening price of the previous white candle. This indicates a critical change in market emotion. The bears are beating down the bulls. The bearish or black candlestick does not have to encompass the white candlestick's shadows. Only the body of the white candlestick has to be surrounded by the black candlestick. As you can see here on the Yahoo graph, the stock price formed a bearish engulfing pattern on 427 and 428. Note that this pattern followed another bearish engulfing pattern on 419 and 420. The bullish and bearish engulfing patterns are important technical signals as they represent major shifts in market sentiment. There are three things to remember to ensure that you are recognizing the right engulfing pattern at the right time: trend, body size, and color. First off, trend. The bearish engulfing pattern occurs during an uptrend and a bullish engulfing pattern occurs during a downtrend. Both indicate potential change in the trend. Secondly, body size. The second candlestick's body must completely engulf the body of the first candle in both patterns. And lastly, color. In the bearish engulfing pattern, the first candlestick must be white and the second candlestick must be black. In the bullish engulfing pattern, the first candlestick must be black and the second candle must be white. The two candlesticks in each pattern are always opposite colors. Turning our attention to another pattern, Harami patterns. Here's an investor tip regarding them. Harami patterns are the opposite of engulfing patterns. With a Harami pattern, you should be able to fit the body of the second candle within the body of the first candle. A Harami pattern is similar to an engulfing pattern and has similar implications, but it differs in three ways. First, in Harami pattern, the body of the first candlestick must encompass the body of the second candlestick instead of the other way around. The second color of the two candlesticks do not have to be different from each other. Lastly, the second candlestick should be much smaller than the first candlestick. Like many other candle patterns, the Harami has a Western bar chart equivalent known as an inside day. Both Haramis and inside days can occur in positive or negative trends. Haramis that occur in an uptrend indicate a bearish reversal signal, while those that appear in a downtrend indicate bullish reversal signals. When a Harami pattern occurs at the top of the trend, it tends to be more valid. When it occurs at the bottom of a trend, remember, the greater the difference between the sizes of the two candles, the more valid the signal becomes. In fact, the ideal Harami would include an unusually large first candle and a doji for the second candle. As you can see on this General Electric graph, the stock price formed another bullish Harami pattern on 324 and 325. Haramis are important technical signals as they represent major shifts in market sentiment. There are three important things to remember to ensure you are recognizing the Haramis at the right time: trend, body size, and color. First of all, trend. Haramis occur during both up and down trends. Next, body size. The first candlestick's body must completely engulf the body of the second candle. And lastly, color. When you're looking at Haramis, the color of the candlestick is not important. The final patterns we will examine are also trend reversal signals. A dark cloud cover is a bearish signal, while a piercing line is a bullish signal. Although these signals are new concepts, they are not dissimilar to the bearish and bullish engulfing patterns already discussed. Starting with the dark cloud cover pattern, the dark cloud cover pattern is a bearish signal that includes both white and a black candle. Although the pattern is normally associated with trend tops, it can also be used to identify peaks of congestion zones, areas in which the stock trades in a narrow range. A dark cloud cover is composed of a long white candlestick followed by a black candlestick that opens above the white candlestick's closing price and closes deep within the body of the previous white candle. To be considered a dark cloud cover formation, the pattern must meet the following three requirements. The first candlestick must be both longer than the usual and white. The second candlestick must be black and have an opening price that is higher than the previous candlestick's closing price. and the black candlestick's closing price must be below the halfway point of the body of the previous white candlestick. As you can see on this Yahoo graph, the stock price formed a dark cloud cover formation on 112 and 113. Note the bearish haramis on 211 and 212 and the hammer on 1217. The piercing line pattern is the exact opposite of the dark cloud cover pattern. A piercing line is a bullish reversal signal that occurs at the bottom of a downtrend or the valleys of a congestion zone. Piercing line formations consist of a long black candlestick followed by a white candlestick that opens below the closing price of the black candlestick and closes deep within the body of the previous black candlestick. To be considered a piercing line formation, the pattern must meet three requirements. First of all, the first candlestick must be both longer than the usual and black. Next, the second candlestick must be white and have an opening price that is lower than the previous candlestick's closing price. And lastly, the white candlestick's closing price must be above the halfway point of the body of the previous black candlestick. As you can see on this Home Depot graph, the stock price formed a piercing line pattern on 5.7 and 5.10. This pattern was followed by a very profitable uptrend. Dark cloud cover and piercing lines are important technical signals as they represent major shifts in market sentiment. There are three important things to remember to ensure you are recognizing the right patterns at the right time. First, trend. The dark cloud cover pattern occurs during an uptrend, while a piercing line pattern occurs during a downtrend. Both indicate a potential change in trend. Secondly, body size. The second candlestick's body must penetrate through more than half the body of the first candlestick in both patterns. And lastly, color. The first candlestick in the dark cloud cover pattern must be white, and the second candlestick must be black. The first candlestick in the piercing line pattern must be black, and the second candlestick must be white. The two candlesticks are always opposite colors. Candlestick analysis is an important component of modern technical analysis. The patterns we have discussed are most popular reversal patterns in current practice. They are not comprehensive of all candlestick patterns available. They do, however, represent a great way to get started with common and reliable patterns. Practice identifying market tops and bottoms on a stock of your choice using candlesticks. Try to track the reliability of those signals and compare your results with a buy and hold strategy over the same time period. We will use candlesticks in each of the following segments. Make sure you feel comfortable identifying those patterns we have discussed so far. And that ends this segment of technical analysis and basic charting. Thank you.